Here we are then, principles of clearing and margin. This is all factual. There's very little concept in here, mostly factual. Starting with the clearing process. We've used this term clearing quite a few times. We've talked about the clearing house, but what exactly does the clearing house do? What do we mean by clearing? Because when you think of the life cycle of a trade, if you like, you think of the execution first, and then at the end, there's the settlement, where, you know, it's re-registered in the name of the buyer, title is changed, etc. But in between execution and settlement comes clearing. And if you're asked in the exam what that is, here's your answer. It's the process through which the trade is confirmed and registered. Now, we know that clearing is done via the clearing house. The clearing house is a central counterparty. Why is it called a central counterparty? Because that's exactly what it is. It's a counterparty that comes in between the buyer and the seller. And it actually splits their transaction up into two. Let's say you've got the buyer here and the seller here. The clearinghouse will step in between them and basically break the trade into two. The clearinghouse will buy from the seller and then will sell to the buyer. So the clearinghouse becomes the buyer to the seller and also becomes the seller to the buyer. In other words, the clearinghouse is taking both sides of this transaction. It is exposed to risk on both sides. It is actually taking on both of these positions. So yes, there is risk involved. And of course, for that reason, the clearinghouse does charge for those services. Any transaction you do on the exchange, part of your costs will go back to the clearinghouse. But quite clearly, it is central between the two parties. And what does it do? Well, of course, it reduces counterparty risk by taking that risk on itself. So it alleviates these two parties. It also, well, it guarantees the performance of the contract. So if one side defaults, it's now the clearinghouse's responsibility to honour the other side. So it does guarantee that the contract will be performed. And of course, that means a high degree of confidence in the system. Good. It also acts as the registrar. Registrar, of course, keeps a record of who owns what. Okay. There's a keeping on target on the right-hand side here. Asks, when does the clearinghouse actually become the counterparty to a trade? When does it become counterparty to a trade? D. Yeah. When the trade is registered. That's what we're looking at here. Good. This next slide, I'm going to leave this to you guys. We've looked at something similar to this yesterday. I'll just repeat what I said yesterday. The examiner, when it comes to clearinghouses, the examiner will tend to focus on the UK. So I would say CME Group as well, the UK and the US. Now that's not to say they couldn't test you on something else, I can't say that, but it's less likely. Okay. Just continuing this theme now in this next slide on the clearinghouse and how it works. The process that I just described back here is called novation, and we're looking at it with a slightly tidier diagram now rather than my freehand. This is what we're looking at. The clearinghouse novating a trade. Novation is the name of the process, the term that we use for this process. The process is where the clearinghouse comes in, as I said, splits the trade up, and acts as a principal on both sides. It is a principal-to-principal transaction because that's exactly what the clearinghouse is doing. They're taking a position on both sides, and if you remember from yesterday, when you take a position on your own book, you are acting as a principal rather than as an agent. Now, let's write that in. It's a principal-to-principal transaction. The clearinghouse covers each member against the default of the other, but it's important to remember that the clearinghouse, and I'm going to use the term sees in quote marks, only the member firm. And what I mean by that is that, let's say this firm, let's call them A and B. Let's say A has a client who defaults. If that's the case, will the clearinghouse cover A against that? No, that's not their job. If this client defaults, it's up to the clearinghouse, it's up to firm A to sort that out. It's their client, it's their problem. However, if A was to default, then the clearinghouse would cover B against A's default. Okay? So yes, it covers one firm against the default of another member firm. What's the answer to the keeping on target then, on the right-hand side? Which of the following does a clearinghouse guarantee the trades of? It's got to be A, isn't it? All clearing members. It's not only GCMs, not only ICMs, it's all clearing members. Good. Now keep in mind that this is derivatives. We're talking about contingent liability instruments here, aren't we? By the way, what's a contingent liability? When you can lose more than you originally put down. That's right. Okay, now that to me sounds very risky. Yes, it is. And the clearinghouse is taking on at least some of this risk. Okay. The clearinghouse will give protection to counterparties, though, should default occur. That's right. That's what they do. How does this work? Well, there are two different systems in use. In this country, we use something called a mutual guarantee. Or I should say the clearinghouse uses a mutual guarantee system. This consists of a default fund. And if necessary, that default fund is there for the clearinghouse to go to in the event of a large default. The default fund is based on contributions made by member firms. The firms themselves pay into this, and it's based on proportionate volume and proportionate value of their average trading. Now, I don't think the examiner will go into this level of detail, but just in case, just to give you an example, if a firm is being assessed on how much of the pool, what percentage of the total pool should a firm contribute? It might be worked out like this. Let's say they take the proportional volume first. Let's say the proportional volume for this firm was 5%. It's going to be the proportional volume over 2. That's going to be 5% divided by 2. And then they'll add to that the proportional value. And we're talking about a percentage of the value of the total trading. The proportional value divided by 2. Let's say this firm was contributing 9% of the value of trading. 9% over 2. So you've got 5% over 2 plus 9% over 2, 2.5% plus 4.5%, that's 7%. That is how much this firm would contribute. That is their percentage contribution to the fund. 7%, based on these two things. So these firms all put in a certain amount, sets up the pool. Now, will that pool be required? Hopefully no, but it's there just in case. Now, what you need to know for the exam is, what if a firm defaults? Now, this is a likely question. What if a firm defaults? What does the clearinghouse do first to put this right? Now, I'm going to number these. Step 1. They will go straight to whatever margin that firm has posted. And hopefully that will be enough to take care of the default. What if the margin is not enough? They will now go back and they will look at how much that firm has contributed to the default fund, and they'll take the remainder from there. So first, they'll use the firm's margin, which is probably enough. If not, they'll take out that firm's contribution to this fund. What if that wasn't enough? Well, now you're talking a major default. But if that's not enough, they're now going to go back into the fund itself, and they're going to have to take out as much from the fund as necessary to cover. What if it was a monumental default by a number of firms? It have to be a number of firms. In that case, the clearinghouse has used up all of its options except for one, itself. The clearinghouse would be the last man standing, would say, we will cover it ourselves. How far do you think we've ever gone in this? What's the biggest default we've had in recent times? Lehman, probably. Don't think it went past 1. I'm not even sure we've been into 2, to be honest with you, but we might have. But we've certainly never been beyond 2. This is a pretty solid structure, pretty solid system. And for the exam, know the steps. Okay? Now in the UK, this is the system that the London Clearinghouse uses, for instance. But be aware there is another system called the independent guarantee. Now this might be used in the States, in the US. This is where there is no default fund. This time, if there is a default, number 1, the clearinghouse goes to the member's margin. If that's not enough, the clearinghouse says, we'll do it ourselves. We're heavily insured against this eventuality. We will cover it. So there's no default fund. That's the difference. Now, let's get into the engine of this. Initial margin. Margin, first of all, think of it as collateral. It's a deposit. Initial margin is just that, actually. It's a deposit. If you look at the right-hand side, in the further information box, it mentions that margin is always payable on contingent liability instruments. Of course, this is the clearinghouse giving itself some kind of cushion. You know, these are very volatile instruments. Clearinghouse needs some kind of security. So when you take on a position, you'll be asked to post a percentage of the value of that position as a deposit. Okay, if you look at the further information box, if you count 4 lines up from the bottom there, I would highlight this. Initial margin, which is posted at the beginning, is described as a returnable good faith deposit. And then it goes on to say that it represents the worst probable one-day loss. Not worst possible, worst probable. And this margin, however much it's assessed to be, it will be payable by 9 o'clock, 9 a.m. the next business day. Now, worst probable one-day loss. Is anybody familiar with VAR, value at risk? Okay, it's a similar scenario, isn't it? Let's run through the probabilities and figure out what's the worst probable scenario here. What they look at is the volatility of the market, etc., and they'll try and come up with a, with a figure that represents statistically what's the probable worst case scenario here. How much value could this lose in one day? Okay, and that is what they'll assess your initial margin on. Now, the way it works is that have a very powerful package, software package if you like, called SPAN, Standard Portfolio Analysis of Risk. And what will happen is that this will run through the company's portfolio, looking at all their positions. In some cases, it'll put these positions together into little mini portfolios. And essentially, it will come up with this worst probable loss. And that will be what you're assessed at for margin purposes, initial margin purposes. Now, again, if you look at the right-hand side, in the hints box at the bottom, there's another cultural difference between the UK and the US here. In the UK, as I mentioned, the positions that you have, some of them will be put together. For instance, if you've got spread transactions, you've gone long a September future on an asset, and you also short a December future on an asset. Now it'll put those together and say, you know what you've got here is a spread where there's actually limited potential loss here. So there'll be less margin required here because it's a less risky position. In the US, it won't do that. In the US, they'll see both positions, they'll assess the risk of each position and add them together. So what I'm saying is, as it says in the box here, in the UK, SPAN groups all contracts by assets and calculates the risk of each portfolio. In other words, they can be netted. It's done on a net basis. But below that, it says in the US, treats each contract separately. In other words, it's gross. It simply adds everything together as if they're separate risks. Okay. All right, let's go to the next slide. This is still with initial margin. This is how SPAN is going to do this. Scanning risk, what's that? Worst probable one-day loss. And then they will add on for any inter-month charges. You'll see these defined on the right-hand side, inter-month charges, inter-commodity credits, spot month charges. Inter-month charges are for any intra-market spreads. For instance, if you're long a June contract and short a September contract, initially, think of it this way. It's almost as if the software initially sees a June contract and then a September contract for the same asset, sees the contract for the same asset, nets them out and says 0. But then says, wait a minute, hold on, one is for June, one is for December. There is a little bit of risk in there. There is a difference. So I will add on a small amount for that. Because they're not offsetting contracts. There is a small element of risk. Spot month charges are when a contract gets into its final month, the delivery month. Do you remember yesterday I mentioned that the majority of people that enter into contracts do not hold them to delivery? They're speculating. What often happens is that the people will tend to wait until the last month. When you get into that last delivery month, you're thinking, you know what? I've got to get out of this contract now. Whichever way it's gone, I better get out. Otherwise, I'm going to be delivered. So there is typically an uptick in the volume of trading in the delivery month. Any contract that's in its delivery month will see an increase in the amount of trading. Now that can also mean an increase in the volatility. And in this world of ours, volatility equals risk. Greater the volatility, the greater the risk. So when a contract comes into its final, or if a contract is in its final delivery month, a higher level of margin will be assessed for that contract because it's deemed to have a greater inbuilt risk. Let's say you're long a UK gilt and you're short the German Bund. Initially, SPAN will assess that as two separate positions, two separate risks, add them together, and then just imagine it realizes that, wait a minute, hold on, the German Bund and the UK gilt are very closely correlated. Actually, these two positions virtually offset each other. The amount of risk is virtually 0. In that case, we can give you a credit for that. We'll take that away from your margin. Because what we originally thought did require margin does not. Okay, they're very similar positions and one offsets the other. All right, put those all together and you've now got the amount that you're going to be assessed at the beginning, your initial margin. Now, if we go to the next slide, I'm going to start with intraday margin here. At any given time in this process, we're not just talking about the initial, now we're talking at any stage going forward. On any particular day, you could be told that you're going to be required to post additional margin. The reason for that is because the market has suddenly become volatile. Maybe there's some economic news. Maybe something has happened somewhere in the world, a geopolitical event, and the market is really roiling. In that case, volatility has increased, risk has increased. You'll be asked to temporarily post more margin until the volatility dies down. Once it dies down, you'll get that back. It's no longer required. So it's additional margin if the market becomes volatile. Short notice. For an OTC, yes, there'll be some kind of provisions, hopefully, in there, if they've been thorough. Okay, spread margin. All we need to know about spread margin, because we've done spreads this morning, what kind of investment strategies are spreads? Conservative. Low profit, low loss potential, which means they're low risk. Good, which means the clearinghouse thinks, well, that's good, less risk, so therefore we don't need as much margin because the risk is lower. back up to the top. Net liquidation value. What this is basically is, let's say you've got options. Now let's just think this through for a moment. If you're long an option, do you post margin? And if so, how much? You don't post margin, do you? If you've bought an option, when do you normally pay for it? Up front. You've already paid for it. You now own an asset. You actually get a credit for the value of your option. It's paid for. The worst that can happen is it loses its value, but the point is it's already paid for. Great. Are all options paid up front? Not if it's an option on a future. If it's an option on a future, then you would have to post some margin because you haven't paid anything yet. What if you're short an option? What if you're short a call? Unlimited potential liability. Yeah, you bet. If you're short, you will have to post margin. If you're long an option, as long as it's not an option on a future, you don't. So you'll get a credit or a debit. A credit if you're long and a debit if you're short. Okay, and we're talking about options here. And the value at any given time will be the NLV. In other words, the net liquidation value. In other words, if you sold it at that exact point in time, what would it be worth? NLV. I'm just going to draw a line across here. What we're looking at in the lower part is TIMS, theoretical intermarket margining system. You don't need to know a heck of a lot about this for this exam. Just know what it is. TIMS is used in the US by the Options Clearing Corporation. It's similar to SPAN. It does the same thing. It assesses margin. It's actually been supplanted recently by another system called STANS. So gradually, TIMS will be phased out and STANS. TIM will be replaced by STAN. There you go.